So I'll recap a few things that, Alan had talked about on the small business retirement plan side and go over some of the highlights. But what we're trying to do here is start small of what business owners can do, getting them introduced to retirement plans. And then as their needs grow for putting more money away, tax efficiency needs, we can actually move up through the food chain and put them into better plans. But just recapping a few things about the SEP that, Alan was speaking to is these are really easy plans to run. They are very little costs. You don't have to file any IRS forms. So it's very efficient. You don't have to pay someone to do the filings. The only downfall is when you do these SEPs, as Alan speak to, is everybody has to get the same amount. So if I own a business, I got 5 employees, and I want to give myself 20% of compensation, I have to give every one of my employees 20%. Okay? Some business owners are okay with that. I will tell you 90% of the business owners that I work with are not. 10% are. So that becomes a hindrance on the SEP. Some of the other things too with the SEP is the eligibility becomes very short thresholds to overcome. So if you have an employee that meets these eligibility requirements of being 21 years of age, if they were basically employed with you 3 out of the last 5 preceding years, and if they have $750 in earnings or more, they become eligible. $750 is not much, particularly when you see a lot of businesses that have part-time employees. There's ways with retirement plans, with 401ks, that we can exclude them. With SEPs, you can't. So again, the hurdles for the SEP are very easy to meet the eligibility needs. They're constraining on the business owner of not being able to have flexibility of giving more money to themselves or some of the other business owners versus giving it to their employees. The limits. This does come into problems sometimes too with businesses. So you can do up to 25% of the employee's total compensation or a maximum of $69,000. And if you're self-employed, particularly, and I know Alan was talking to individuals that don't have employees, you can do 20% of your net income. Let's just say if you have a small business that's doing net income of $100,000, 20% of that is only $20,000. So there are sometimes people, that have needs to put away more money than that. Well, with the SEP, you could run in constraints because of these limitations here on income. Yes. It's 20% of the on the owner side. It's if you're self-employed. If you have employees, it's 25%. So it's a difference. Tax code is great. All these percentages change and move. Simple IRAs, again, recapping, very easy to run. This is where employers want the ability for their employees to be able to defer something out of their pay. There is no employer, profit sharing or SEP contributions. There is a match that will be required with a simple. But with a simple, if you're an employer, you have more than 100 employees, you can't have a simple. Now, I run into this question all the time. January 1st, I didn't have 100 employees. I have a simple. June 1st, I now have 125 employees. What do? You run it for the rest of the year. December 31st, you shut it down and you move to a 401k, or you just do nothing. That's your only option. Mm-hmm.
And I would like to interrupt and say, if you have more than 20 employees, a simple
eligibility
IRA
rules,
gets
again, a really low bar on a simple plan.
to run. So
if your
my
employees
business
receive at
owners,
least
when they get over
$5,000 in
20
compensation the preceding 2 years,
401k,
they're eligible
it's
for the
just
simple.
too much work to do for
so you
20
can't
employees.
keep employees out of it. The limits aren't too bad. Kind of as Alan alluded to, you can do up to 100% of compensation of $16,000. Now, I am not an accountant. I can't give tax advice, but I will tell you a lot of times when I sit down with business owners, and if it's a family business, I say, does your spouse work for the business? Does your spouse work outside the house? And they're like, no, my spouse doesn't work outside the house, and they're not necessarily on the books of the business. I said, well, talk to your CPA. Maybe it makes sense for them to do something in the business, and magically they make $16,000 a year. So that $16,000 that you pay their spouse, or you pay your spouse, you just put it 100% into the simple for tax purposes. So, go ahead.
I'll add some stuff. I spoke about one of my vets. His daughter, I think she's 12. CPA cleared her to come in. He pays her to come in and sweep up and clean kennels, and she has earned income. You need earned income to throw into a traditional IRA or a Roth IRA. A Roth IRA, once it's there for 5 years, is the principal. You have access to that principal tax-free. So that's just something that some business owners can
their
use.
kids. I've seen individuals that have websites.
Work,
they use their kids
earn income
on the website,
and now you can start saving for their retirement or a down payment on the car or something.
So, very constructive ways of what you can do and how you can set up a business. Again, talk with Alan, we'll walk you through it. With a simple, there is a requirement for businesses to give employees money. There's what we call a 3% matching contribution, which means the employer is only obligated to match an employee if they choose to participate in the plan. And the match is dollar for dollar up to 3% of compensation, okay? The second option is what we call a non-elective contribution, where they just say, once you're eligible for the plan, I'm going to give you 2% of pay. Some people will ask me, Dennis, why do a 3% matching versus a 2% non-elective? And it's really a conversation with the business owner. If the business owner had employees and thought all the employees would contribute at 3% or more, it might be in their financial interest in lowering expenses, just give all employees 2%. So in essence, what you've done here is I've created a savings for my payroll of 1% of payroll, because I'm only giving my employees 2% versus matching everybody that's going to put in 3% or more in the plan. So there's some different ideas there. The money that the employer puts in, this matching, it's 100% immediately vested, which means as soon as you as the employer or the employer gives that to their employee, if they decide that job is no longer right for them and they go across the street to another employer, whatever match the employer gives them is automatically theirs. They take it with them. There is no vesting schedule, right? Something here, I will mention the 2-year rule on the 25%. In case you or a loved one or an individual ever comes across this with a simple. If you have a simple, you must maintain that simple plan for 2 years prior to rolling it over to like an IRA. Okay, so I'll give you an example. Let's just say I worked at a company and I only had the simple for a year. I terminated my employment and I had $10,000 in my simple and I rolled it over to a IRA. Well, if the government finds out, I have to pay a 25% penalty on that $10,000 that I rolled over. It's pretty steep. Okay, so that's just something that should know about simples. Secure Act 2.0. Secure Act 2.0 is something that was rolled out towards the end of December 2023 with some new tax law changes, which we had to put in effect. One of them is simple IRAs now allow for Roth contributions. Roth contributions is where you as an individual employee put money away after taxes. So you pay the taxes today. Nice thing about that Roth money is it grows basically tax-free. As long as you take it when you're in retirement, whatever it is grown to is free and clear your money. You don't have to pay any taxes on it. I will tell you on the simple side, we don't do simples. On the simple side, I don't know many that have allowed it for the Roth contributions to be set up. You know what? I'm sorry. Roth contributions. I'm thinking there's another thing where employer match. It's part of legislation. Employer match can now be in the form of Roth contributions. That's a whole nother story, and it gets very complicated. But the simples of allowing for Roth contributions, it is. But I don't know if a bunch of vendors have implemented it yet. So I don't know. Yours. Yeah. Yeah. So, but that's on the simples. So moving into the qualified plan space, I'll talk about profit sharing plans, 401k plans. Individual solo Ks, which are going to look, smell, walk, talk like 401k plans, but they're just for an individual versus if you have employees. And then I'll get into cash balance plans, is really where we can put away a lot of money. Profit sharing plan, I'll start there. Interesting enough, profit sharing plans date back to the 1800s. When I first started doing this, I was like, back to the 1800s, I couldn't believe it. But But profit sharing plans are pretty easy to run. I will tell you, I very, very rarely run across a profit sharing plan that's not set up in conjunction with a 401k plan. But businesses can run a profit sharing plan. And to Alan's comment earlier, there were some tax law changes within the past few years where a profit sharing, you could only make a profit sharing contribution as long as you had a plan set up, okay? And it had to be in the year that you were making it. Now you can go back. So what do I mean by that is, so let's just say we get into 2025, you're a business owner and you say, you know what, I sat down with my CPA and I got a large tax bill. What are my options? Well, if you didn't have a profit sharing, you can now go back to 2024 and make a contribution to a profit sharing to lower your tax liability. Historically, 2 years ago, you couldn't do that. Okay, it had to be basically set up and made made in that year. You couldn't go backwards and set up a plan. So you do have flexibility now with the profit sharing. Contributions to a plan, you can into a profit sharing, you can put 100% of your compensation. You're going to see this limit a few times. $345,000. This is the maximum, basically, compensation the IRS will allow for 2022 when you're factoring in a lot of retirement plan benefits. Okay, so if you were, I'll show you some plan testing later, but if you were to look at some plan testing and I have business owners who make $1 million, but when I'm doing design with them, I'm just going to put on the paper $345,000. They're like, but I make more than that. I'm like, yes, you do, but the IRS says this is the only income that we can take into account for your income limits for 2024. But you can do up to 100% of an individual's annual compensation up to a contribution of $69,000 for a profit sharing contribution. There are certain rules with profit sharing plans that become problematic. A business owner just can't give it to themselves. They have to give it some to their employees too. And if a business owner has too much money in the plan, if it's a certain plan design, if 60% of the assets or more in the plan are theirs, they have to give everybody basically the 3% of compensation. It's called a top-heavy test. So just be aware of that. Any contributions are deductions for the employer. So if they take $60,000 and put it into the profit-sharing plan, that reduces the income for the business as a business expense by $60,000. So that's why a lot of these become very good tax planning strategies, because business owners are reducing their taxable income. Because I tell a business owner, you've always had two options if you've been successful and had a good year. The two things that are guaranteed, you can pay the government in taxes, all right? The other option is you can go buy equipment, right? Sometimes you need equipment. I've done plans for farmers, and I've seen $700,000 combines sitting under a roof. And they're like, I needed a tax deduction. So that's why I bought it. I'm like, it's a depreciating item. You don't use it. It's like, there's other ways you could have did it. It's like, well, my CPA didn't tell me. So, or my advisor. Profit sharing plans, you can put a vesting schedule on it. That means is it can go up to 6 years or a 3-year cliff. So an employee has to be with you for a full 6 years before any money you've given them is 100% theirs if they walk across the street or leave the company. You can allow in-service distributions or hardships on profit sharing. There are multiple different tests that we can go. This is kind of getting into retirement plan design. A lot of that we do with some of our third-party administration partners. But this is called a plan design illustration. On the left-hand side, it looks at the employees. And in retirement plans, we segment or segregate employees into two groups. Group A is your principals and owners, family members, and anybody who makes more than $155,000. Group B is your general employees. So then what we do here is we start factoring in compensation. Remember my comment earlier is, somebody can make $1 million, but for compensation purposes, for this year, we're just going to say $345,000. So we show them that, but what we're showing you here is if you're doing profit sharing, there are different methods to go under and do it by. So pro rata just means, as you can see here, everybody gets the same percentage. Smells, looks like a SEP, right? Everybody got the same percentage that went in. But what business owners are interested in down here is called the principal share. Of the money that went into the plan, $202,000, how much went to the principals? 64%. Not a bad number, but it could be better. So that's what we tell people. Permitted disparity with this method versus removing from pro rata to permitted disparity. What we do with the business owner is we can say, okay, if the business owner is older, it actually looks at Social Security benefits, and it looks at once you get over a certain amount of income, you don't get any additional Social Security benefits. You don't pay any additional Social Security tax. You're capped out. So for those individuals, we can give them a higher percentage, and that's why you see this person makes $345,000. They got 20%. The rest of the employees got a smaller percentage. So under this method, we got $186,000 and some change into the plan, but 67% of the money went to the owners. They like that a little bit better. Age weighted, exactly what it says. Those individuals that are older, see the 60-year-olds, they got a 54% contribution. Those people that are older in the plan, we can give them a little bit more money, a higher disparity. So with this method, we were able to get $249,000 in the plan, and still we just got the business owners 67%. Cross-tested is what we do with a lot of plans today. It takes every one of these individuals that puts them in their own asset class. But the really powerful thing here is look how much you had to give to the employees, 5%. So the owners and the employees, in total, we put $195,000 in there, but roughly 91 cents on a dollar went to the business owners. They love this. I will tell you, I come across plans nowadays where people still do this, and you're like, do you know there's a better way? And they're like, no. It's like, well, let's have a conversation. Alan and I will come in, we walk them through this. This is where you need to be like, yeah, I want to do this. If I want to give anything extra to my employees, they can do so. The government will never discriminate. And there's minimums you have to give your employees. The employees say, or the employers, or the IRS says you can give your employees more, but this is the minimum you have to give them. So this is some really neat things you can do at profit sharing. But again, profit sharing plans are usually done in conjunction with a 401k. So I'll talk a little bit about the 401k. It is the largest savings vehicle out there. The government is really, really pushing these. I'm going to go through some of the tax code changes where they've put a lot of tax benefits in place. I don't have a magic crystal ball to tell you what the future looks like, but I can tell you what I see going on. Anybody have a parent or grandparent, or even maybe yourself, that you're part of a pension plan where you worked at a company 15, 20 years. You terminated that, and they said, you know what, when you retire, we're going to send you a check. Well, we're going to ACH you every month until the day you pass away. All those types of plans, unless you work for a federal or state government, have pretty much gone away. That used to be a large portion plus Social Security income in retirement for individuals when they retired. So defined benefit plans have went away. The government knows that individuals are not saving enough on their own. They know that Social Security income is not going to supplement them. So governments more and more, even at the state levels, there's now 13 states that require if you have a business, you have to have a retirement plan for your employees. There's no option. North Carolina is not one of those.
Do you see that happening here soon?
I don't know. It's all who's in office. So that's what it's dependent upon at the state. Every state's different. Virginia is 25 employees. And if you have to have 25 employees or more
here soon?
in business for 2 years or more, you have to have a plan. If you don't have a plan, their fine is $100 a day. No, there's no cap in Virginia. So some states do have caps. I think California has a cap, but so it's just interesting. But you're going to see them more and more. Why some individual employers go to 401k plans is you're going to see here the limits step up from what you could do in a simple. You move from $16,000 to $23,000. And I didn't mention this in the simple plan. So the government loves us older people. So once you become 50 or older, they allow us to do what's called a catch-up contribution to reward us for being old. In a simple plan, the catch-up contribution was $3,500. In the 401k plan, you actually get $7,500. So combined, I'm 50 years of age this year, so I can put $30,500 into my 401k plan. That's out of my pay, okay? Matching contributions, an employer can put a vesting schedule on any money that they match the employee, so they don't have to make it immediately vested. Into a 401k profit sharing, the maximum this year is you could do 100% of compensation up to $69,000 between your 401k and profit sharing. That's what I could get away if I was under 50. Over 50, you add your $7,500 to that $69,000. That's your max, all right? $76,500. I'm not going to go through the different types of, it's called safe harbor 401k plans. There's different designs, but this is what we walk business owners through their options. But for today's sake of time, I'm not going to go through it. Solo Ks, all the same limits that I just talked about with a 401k plan, but for a solo 401k, it's only eligible for individuals that are a business owner and they have no employees, or it is a family-held business, okay? Husband and wife, cousins or something that own a company together, they could do a solo K. You don't have to do just a regular 401k. But again, all the benefits are going to look the same. Eligible for businesses that can be incorporated, okay? Partnerships, corporations, sole proprietorships. They are very simple to administer. You don't have to file a 5500. So with a 401k plan, I'm thinking about the simple. You must file the 5500 plan if you're over $250,000 in assets. Every one of us has to file a 1040 tax return, correct? A 401k has to file a tax return. It's on the form 5500 instead of an individual 1040. I don't know if any of you being small business owners, if you have a solo K, but I'll give you a little tip here. Here's what you do. If you set up a solo 401k, and if your assets are reaching this threshold of $250,000 where it would make you have to do a Form 5500, which you're going to have to pay to do typically, set up your solo 401k that allows for in-service distributions, and you just take the money and move it to an IRA, and you stay below that $250,000 cap, and you don't have to pay to have the 5500. Yes. Yep. So it's a little tip out there that you can do, just save your clients money. So. Higher contributions in a 401k. Also, too, you can do the Roth feature. Has anyone ever done a Roth IRA? Roth IRAs are great, which again allows you to put money away after taxes, and it grows whenever you take it at retirement. It is free and clear your money. If it's growing to $50,000, you don't pay any taxes on it. Okay. One of the problems with Roth IRAs that is once you reach a certain income level, you can't do them anymore. 401ks, if I go back to my limits, if I go back to my limits here of $23,750, I can do those limits in the form of pre-tax or Roth or a combination of both in a 401k plan. And there is no income limitation. I can make $1 million a year and I can still make 100% of those contributions in the form of a Roth. So that's the one nice thing about a 401k with the Roth feature is you don't have to worry about your income and being capped out and not being able to do a Roth IRA.
I want to add something to that as well. So if you want to use the 401k to lower your taxable business expenses, there's also a backdoor Roth IRA that some people don't know about. If you don't have any other IRA money, I take my high income clients and we contribute to a traditional IRA.
Any
today,
individuals, sole practitioners?
Tomorrow we convert it to a Roth.
One of the things
now,
you can do too,
regardless of how much money you make,
kind of to the Roth IRA,
you can still contribute to a Roth IRA.
If you have no employees,
still use your 401k
this doesn't
to lower
work
your
a lot of
taxable
times.
business income.
If you have no employees,
One of the
you could do a
strategies that we
401k.
use.
You could put all the money, and you could do money after tax. So this is, again, just a tip here. Let me go back to the limits. So in the 401k, I could put $23,000 out of my paycheck, right? The difference between this limit here of $69,000 and $23,000, that beta or difference there, is made up between employer contributions and profit sharing, but also too, you can do what's called after tax. So what I could actually do is, as if I was a business owner and I didn't have any employees, I could defer $23,000 to my 401k plan. But then the limit says I can put up to $69,000 there for the year. So if I do that subtraction there, I'm at $46,000 is my differential. I could actually take $46,000 and put it into my 401k after tax. Okay? And then I can contact Alan and just say, hey, Alan, take that $46,000, flip it from after tax into a Roth. It's called a mega backdoor. Doing the same thing he's doing with the IRA, but you can do it in the 401k plan.
Never heard of that one.
Yep. So you can, some smaller employers can't do the mega backdoor Roth. John Hancock, we do it. Like I can look at these limits. I put money in each year. The next day after I put the money in, I go in and flip it from basically after tax contributions because I pay taxes on it. I flip it to a Roth. The government it was talked last year they were going to shut it down, but they didn't shut it down yet. So it's still out there. They could shut it down at any time. Yeah, yes. Because you can't I can do this money directly into a Roth, But you can't do profit sharing 100% into a Roth. Yep. So you put it in after tax, and then you flip it directly to the Roth. So, let's see. So solo Ks, kind of closing out the solo Ks here. There is you can do up to 25% of compensation. If you're self-employed, going back to that same rule earlier with steps, it's 20% being self-employed is your limit. The additions will follow the 401k, so no difference there. Cash balance plans, you have a client or an individual that has said, okay, Dennis, you just got me $69,000 in my profit sharing, I can do more. And I will tell you, there's a lot of businesses where people can do more. So a cash balance plan is what we call a defined benefit or a pension plan. But the nice thing is you don't have to give all employees money. There's certain constructions of the plan. For those of you that just own your own business and you do really, really well, you can do a solo 401k or you can just do a cash balance plan. These are roughly the limits based upon age of how much I can get into a cash balance plan. When you do these limits, this is an annual limit of what you can do. They are business expenses. So instead of you taking home this, if I was 67 years old, $376,000, I could do a cash balance contribution. That is a business expense that reduces my profitability. So they are severe numbers. So let me walk you through an example and show you the power of a cash balance plan. Typically, individuals that I see doing a lot of these, sole practitioners that don't have employees, doctors, dentists, attorneys, income 375 or more, land developers. I've done them for chicken farmers. Chicken farmers make money. I will tell you, they make good money. But you see this table, it looks a little bit like the profit sharing design we went through earlier. But this one, what we're going to do is we're going to look at the 401k and we're going to look at a cash balance plan. So this was, you had 2 business owners and you had 5 employees. We looked at income, salary deferrals. In this scenario, we really didn't care what the employees were putting away because whatever the employees put away, it doesn't impact the business owners. So both business owners were 50 years of age or older, so they were able to max out this year, deferring $30,500 out of their pay. We do it's called a safe harbor contribution. We didn't give it to the business owners, and there's a reason because of testing. But we just had to give all the employees 3% of compensation, which come down here is to the tune of $6,900. Not too bad for the business owner. Going back to the profit sharing, remember I talked about a lot of plans to cross-tested. So we cross-tested it. We got the owners about $10,000 and some change. We did have to give the employees some money, but the nice thing here, with this amount, this is 100% the employees' money as soon as I give it to them because it's a safe harbor plan. With profit sharing, when you heard that terminology earlier, I can put a vesting schedule on it. These employees have to be with me for 6 years or more before this money is 100% theirs. So going through the cross-testing, I got the owners $20,000 and some change. I had to give the employees $18,000. So that's going through the 401k and profit sharing. Then we put a cash balance plan on top of it. These are where it gets big. So each business owner, I was able to get $186,000 into the plan. Okay, you have to have cash. This can't be on paper. There has to be cash that goes into the plan and deposited, just so you know. So each business owner, we got them $186,000, okay, to the tune of $372,000. We only had to give the employees $4,600. So you back into all this, what business owners really like is you go in and say, okay, of all the money that went in the plan, I got to the owners $454,000. I only had to give employees $29,000. So I got 94% or 94 cents going on a dollar on $454,000. And oh, by the way, you're talking to business owners are probably, if you're doing this type of planning, they're probably in the all income 40% tax bracket or higher. $454,000, okay? Multiply by 40%, $160,000 in change in taxes. $160,000 in change that you just saved them in taxes. Yes, they had to give their employees $29,000, but if I go to a business owner, okay, Mr. and Mrs. Business Owner, would you rather stroke a check to Washington and then spend the money however they want for $160,000, or would you much rather give your employees $30,000 and you, the other owners, keep $130,000? It's a no-brainer. So these are very beneficial. You work with some business succession. Cash balance plans can be used in business succession. I've worked with dentists where they were selling their practice. For purposes, they were selling it, and you're from Fifth Third, they were selling their business, $1 million. The bank didn't want to lend them, the younger dentist $1 million to buy it out. So what they did is they got constructed. They said, okay, we're going to do a cash balance plan. Me as the owner, I'm going to stay on the books for 3 years. You're going to get me a cash balance contribution in the tune of $200,000 per year. So that's $600,000 over 3 years. I'm going to basically say that's part of the buyout. So on paper, I'm going to sell the business to you for $400,000, not $1 million. From lending purposes for the bank, I'm not lending $1 million because I'm buying it out to the cash balance plan. You only have to now lend $400,000. So there's some really neat things you can do there on the cash balance side. Also too, for the right situations, I worked with an attorney and their wife. They had a very good practice. They were never going to have employees. They made about $370,000 a year combined. They had won a court case, and this was back in 2019. Their court case winnings was $550,000. So they went to their advisor and said, hey, we're going to pay a bunch of taxes on this. What can you do? So they had a 401k plan, but we ended up putting a cash balance plan in place. And for them, since they would never have employees, what we ended up doing is you can front load a cash balance plan. So, and I'll give you some other examples. So what we did for the gentleman and his wife is we put $450,000 in 2019 into their cash balance plan. So we funded it for 2019, 2020, 2021. We created a business expense in 2019 of $450,000. So that was $550,000 on that court case that they won. I created a business expense, so we turned that $550,000 down into a $100,000 gain. They ran the plan for the 3 years and they just shut it down. Business developers, kind of, or if you have a business where you work on contracts, here's another thing that's very, very profitable and lucrative: solar farms. I work with 2 gentlemen that do architectural design of solar farms. Every 3 years or so, they get about a $3 million payout on a project. They are lucrative. So what they do is every 3 years they get a payout. They front load it for 3 years for both partners, and they're waiting for their next project to close out and get paid on it, and then they wash and repeat. So these types of plans and strategies are great tax plans. What I would tell you, and I don't want to hurt anyone's feelings, as don't expect CPAs to know a lot of this, because they don't. Yeah, I guess, but yeah, but the tax efficiency part is the job. But that's where really I tell individuals, get in touch with Alan, get in touch with your advisors. They're going to flush through a bunch of different stuff. And some of these scenarios, I might do 10 of these scenarios and maybe 4 of them work out. But that's what Alan and his team does, is they go through scenarios that basically try to help business owners and look for tax efficiency. So,
yeah. So now that we've mitigated our taxes, we've grown our wealth, let's make sure that we're going to be around to enjoy it.
Die too young.
Dr. Michelle Fritsch.
All right, question, why? Why do we save the money? Why is the money so important?
We can enjoy it in retirement. Enjoy it.
Is it,
There's options.
it does offer options. How much is enough? Or what do you want it for? So I'm going to challenge you a little bit that money has great power and it can do many, many things. And I will tell you, as a clinician, which I've been now for over 30 years, I've seen people with more money they could ever spend in their life, and they pass away so early. I've also seen people with so much money, and they've given it and done so many wonderful things with it. They have found that purpose, and oh my goodness, they've done amazing things with their life. And what is the value of your life? Because I'm going to tell you a story in a second. What's the value of 1 year of your life? I just want you to think about that for a minute. If you were to put a dollar figure on your life, what would you put? Because I would tell you there are people who are doing that. On the healthcare side, for accountability purposes, healthcare does keep track of and puts numbers on values of lives, especially when mistakes are made, when someone doesn't get the care that they should have, somebody's in the hospital longer than they should have been, somebody's no longer able to walk when perhaps they should have been. They put numbers on all of that. And I don't know that we think about that all the time. So I want you to be thinking about that for a second. And then I'm going to challenge you. What are 2 of your absolute top retirement dreams? So those things that you're really saving for that you want to do. What are 2 of your top retirement dreams?
Get to a university.
Everybody thinking of things?
Travel.
Yeah, lots of places that you want to go, things you want to do. Yeah. Do you want to be able to dance with your granddaughter at her wedding?
Yeah, stepping on her feet.
There, even that too, and not wheeling in a wheelchair over her feet, but being able to be able to do those things. So money is a tool. It's a huge tool to do those things we want to do. But you know that my bias is no amount of money can buy health unless you've taken the time to be a little bit more proactive about that. And I think the reason I do what I do is the number of mentors, wonderful people that I worked with. People that, so I'm coming from the world of academic leadership and healthcare leadership. So I'm working with C-suite health executives, professors, deans, people that in my world are household names. And I started watching my mentors who seemed to be fine and they were in charge of everything and they retired and oh my goodness, they faded away so quickly. And some of the reasons were that they were so busy doing those last minute things before retirement that they were putting off their own care. Even when they were physicians, they were putting off their own care, thinking I'll get to that when I get there. Sometimes we don't have that much wiggle room left in our health. Some of them, their relationships fell apart. The last boss I had was somebody who was incredibly well known in that part of the country, at least. And he had worked really hard. He was one of these people that was probably in the office by 6 or 7 every morning. He didn't leave till at least 6 or 7 every evening. He had done this for 40 years. When he announced to his wife he was retiring, he was so excited. He had this whole big display, to tell her he was retiring. What do you suppose she said? Not in this house. You're not going to be in this house. I mean, literally, those are the words she said. For the last 2.5 years, he's been in the library every single day writing books because he has no place to go because the relationships weren't as steady as he wanted. And then there are the people who lose their sense of who they are. You remember, in my world, we've got people who spent 12, 15 years just training for their first job, right? Some of our physicians and our surgeons, they worked so hard for those licenses. How do you retire from that? The day you give up that license, there's no getting it back. And you gave so much of your life to get it. Same with lawyers, right? You work so hard for that opportunity. How do you give that up? So, how do we help people realize that there is so much to their life? There could be so much to their life. There could be so many benefits, so many ways to utilize the funds that they've put away in really important, incredible ways. And so that has become my passion to figure out how do we get in front of that. And there are a lot of strategies for that. Part of it is our healthcare system is really not great at the moment. And so there are a lot of very strategic, simple things you can do to own your own health, to make sure that no mistakes are ever made about your care because you know what to say, how to share it, how to prepare, how to make sure you get everything you need out of the healthcare system. Why wouldn't you want to do that? Same with your risk factors. We've all got different ones. How many people ever had a really bad bicycle accident or a car accident or a something? Those kind of change this ankle will never be quite the same. That's a risk factor. There are ways to make sure you know what those are and mitigate them, handle them, decrease the risks. A piece of it is, I'm going to laugh for a second, family habits. How many family habits do you have? How often on a cold, rainy day do you go for the comfort food, right? I love that they did that today. But family habits are one way that we can kind of decrease our risks and think about those things. And then what is your purpose? What really are you going to do with the next phase of your life? How are you going to make sure your relationships stay strong? There are ways to plan, strategically get in front of all of that and make such a big difference. And then so that's on the personal side. I want to switch gears for a second, talk about businesses, because we are here as a business to business support network, right? For businesses, the reason to help employees, especially employees over 50, think about these things, one of them is think about healthcare costs. When your employees know how to be proactive in their own healthcare, and they're thinking about it, and they're not putting off all those doctor visits, they're not putting off those colonoscopies, even though nobody wants those. If they're not putting it all off, your healthcare costs and your insurance costs go down significantly if those less healthy employees aren't raising the rates. You know, we can really be proactive about that. Another piece is when those employees see what's on the other side and they're ready to retire, they're actually excited about retiring, then when you, the business owner, are ready for them to retire, it will be an easy, smooth, low friction transaction. Versus, how many times have you seen employees who they've been there a long time, they've got kind of proprietary information for the business, and they hide it as a self-protective mechanism. You can't fire me, or you can't tell me to retire. I know elements of this business nobody else knows, therefore, I'm not going anywhere. If we can help them see their future in a positive way, redefine themselves and their self-worth and their value in a new way, then they're going to spend the years left in your employment focusing on the business. You're going to get so much more real benefit from them being in your employ rather than hiding proprietary information. So there are a lot of benefits to businesses taking a look at this and really making this part of helping employees plan their future for the benefit of the business and of the employee. So my goal for everyone is when the last day comes. Yes, you've got money. You've got money to have done what you wanted to do. You're not fully run out when the last day comes. You've been able to help future generations in a positive, proactive way, partly because you lived in purpose and left a great legacy. And so they are ready to do the same. But a piece of it is do you want to spend your last day, kind of baseball analogy, here's home plate. You're like barely making it over the line with your walker or somebody's wheeling you in a bed? Or do you want to come sliding across home plate, wind flying, your messy, dirty, scratched up laughing, your biggest laugh, saying that was a wild ride. So if that can happen, and I say that the wellness portfolio with the financial portfolio is what makes that happen.